what the next crisis will not look like. It will not arrive with familiar warning signs or repeat the patterns everyone expects. It will not resemble the charts, timelines, or collapses etched into financial memory. And that is exactly what will make it so dangerous. The next crisis will emerge from blind spots created by the very success in preventing previous crises. It will exploit the assumptions embedded in protective systems, finding vulnerabilities precisely where confidence is highest and vigilance lowest. To understand why the next crisis will feel different, we need to look at how preparation shapes blind spots. Every major disruption leaves behind lessons, frameworks, and defenses designed to prevent recurrence. Institutions adapt. Regulators reform. Markets internalize the experience. Over time, the last crisis becomes a template for what risk is supposed to look like. The Great Depression taught lessons about bank runs and liquidity. The 2008 crisis taught lessons about leverage and interconnectedness. Each historical episode becomes a case study, its warning signs cataloged, its dynamics modeled, its prevention formalized into regulation and procedure. This process strengthens the system, but selectively, safeguards grow dense around known failures. Capital is positioned where danger once emerged. Oversight tightens around familiar vulnerabilities. The system becomes resilient to what it already understands, while quietly exposing itself to what it does not. Banks hold more capital against credit risk, but may underestimate operational risk. Regulators monitor traditional institutions closely, but struggle with shadow banking. Models calibrated on past crises perform brilliantly on historical data, while missing novel dynamics. As conditions change, risk shifts shape. It moves away from obvious pressure points into areas considered stable. It hides inside interactions rather than institutions. It builds through behavior rather than balance sheets. What looks calm on the surface often reflects risk migrating beneath it. When regulations tighten in one sector, activity flows to less regulated alternatives. When specific instruments are restricted, innovation creates new ones that serve similar functions but escape oversight. Risk is hydraulic. It moves to wherever resistance is lowest. Early signals rarely feel dramatic. They appear as anomalies, minor disruptions that resolve quickly, metrics that behave oddly but remain within tolerance. Each event is explainable on its own. Together, they hint at a system adapting faster than its defenses. A sudden spike in repo market rates gets attributed to technical factors. Unusual correlations between asset classes get dismissed as temporary. Liquidity disruptions in obscure markets get overlooked as isolated incidents. None rises to the level of emergency, yet collectively they suggest deeper shifts in system behavior. Markets reinforce this illusion. Confidence grows as familiar dangers remain absent. Volatility feels contained. Interventions work as expected. The absence of crisis becomes evidence that safeguards are effective, even as the system drifts into unfamiliar territory. Extended periods of calm breed complacency. Risk premiums compress. Leverage increases. Investors reach for yield in progressively more exotic instruments. The very stability created by safeguards encourages behaviors that undermine that stability, a fundamental paradox of risk management. This is how the next crisis takes shape. Not through repetition, but through deviation. It forms in the space between what is monitored and what is emerging. It grows where attention is lowest and assumptions are strongest. The danger zone is not where everyone is watching, but where no one thinks to look. It exists in the assumptions so fundamental they go unquestioned, in the correlations assumed stable that suddenly shift, in the behaviors considered rational that prove collectively destabilizing. The most important realization comes early. The next crisis will not announce itself as a crisis. It will look like normal variation, manageable noise, or temporary adjustment, right up until it's no longer any of those things. The transition from manageable to critical can be abrupt and nonlinear. Systems that appear stable can undergo sudden phase transitions, where small additional stresses trigger cascading failures. The margin between normalcy and emergency may be narrower than anyone realizes. And by the time it looks familiar, it will already be too late. Once the pattern becomes recognizable as a crisis, the optimal window for intervention has usually passed. The most effective responses come early, when the situation still seems manageable and intervention feels premature. But this requires recognizing danger before it conforms to established templates, precisely when institutional incentives discourage alarm. As the system moves further from the last disaster, confidence reshapes perception. Safeguards appear to work. Models remain calm. Markets absorb shocks that once would have caused alarm. Each success reinforces a belief that the lessons have been learned and that the next threat will be recognizable when it appears. Success breeds confidence. Confidence breeds complacency, and complacency breeds vulnerability. The longer the system operates without major disruption, the more convinced participants become that current defenses are adequate. But risk rarely repeats itself in the same form. It evolves. It adapts to the defenses built against it. Pressure shifts into places that feel routine, technical, or too small to matter. What once demanded attention becomes background noise. Familiar stability masks unfamiliar exposure, like pathogens evolving resistance to antibiotics. Financial risks evolve to circumvent regulatory constraints. New instruments, new markets, new networks of interconnection emerge that have not been stress tested because they did not exist during previous crises. This evolution changes where warning signs appear. Instead of dramatic failures, signals surface as friction, minor liquidity disruptions, unexpected correlations, behavioral shifts that feel temporary. None of these trigger emergency responses. They are monitored, discussed, and then absorbed into revised expectations. Analysts explain away anomalies. Market participants adapt to new norms. What should prompt investigation instead becomes normalized. The baseline shifts incrementally until behaviors that would once have alarmed now seem ordinary. Institutions adapt rationally. They hedge what is visible. They optimize for measured risk. They trust indicators that have proven reliable in the past. What cannot be clearly modeled is treated as secondary. Over time, attention narrows around what can be quantified easily. Risk management becomes increasingly sophisticated at measuring certain types of risk, while growing blind to others that resist quantification. The precision of measurement creates false confidence that what is measured represents total risk. Markets mirror this focus. Price movements align with expected narratives. Volatility clusters around known events. Confidence builds around predictability. The system feels prepared because it is busy watching places it expects danger to come from. Trading strategies optimize for historical patterns. Portfolio construction assumes that past correlations will persist. Hedging protects against scenarios that have happened before. Everyone watches the same indicators, creating crowded trades and synchronized behaviors that themselves become sources of instability. Regulators face the same constraint. Oversight frameworks evolve incrementally. Each update addresses a specific gap revealed by history. But structure limits imagination. Monitoring follows definitions, and definitions lag behavior. Emerging risk does not violate rules. It bypasses them. Regulatory architecture is built on categories that may no longer capture reality. New forms of intermediation, new channels of contagion, new feedback loops develop outside the conceptual framework within which oversight operates. Public perception follows outcomes, not mechanisms. As long as disruptions remain contained, trust holds. The absence of crisis becomes reassurance. Few ask whether stability reflects resilience or simply unfamiliar risk building quietly elsewhere. Political pressure to regulate eases during calm periods. Media attention drifts to other topics. The urgency that drives reform immediately after crisis dissipates as memory fades. This predictable cycle ensures that defenses erode precisely when risk is accumulating. This is the silent progression. A system hardened against repetition becomes vulnerable to surprise. Preparation creates comfort. Comfort reduces curiosity. And curiosity is often the first line of defense against the unknown. The organizations and individuals most responsible for stability become invested in narratives of success. Challenging those narratives becomes uncomfortable. Questions that might reveal vulnerability get dismissed as pessimistic or uninformed. The system develops intellectual rigidity at precisely the moment when flexibility matters most. The next crisis will not break the rules. It will exploit the assumptions beneath them. It will emerge from premises so fundamental that they function as invisible axioms rather than testable hypotheses. Perhaps the assumption that certain markets will always have liquidity. Perhaps the assumption that certain counterparties will always be solvent. Perhaps the assumption that certain correlations will remain stable. When foundational assumptions fail, entire analytical frameworks collapse simultaneously. The reckoning comes not with sudden collapse, but with recognition. The system realizes that its greatest offenses were built against the past, while its vulnerabilities formed in unfamiliar space. Stability returns gradually, but with fewer illusions and deeper caution. The aftermath brings painful acknowledgement that confidence was misplaced, that preparedness was incomplete, that the warning signs were visible but unrecognized. The post-mortem reveals in hindsight what should have been obvious in real time, but was obscured by assumptions and attention focused elsewhere. In the aftermath, reflection replaces certainty. Policymakers review not just what failed, but what went unnoticed. Attention shifts toward weak signals, behavioral patterns, and interactions that defy classification. Oversight expands beyond institutions into flows, networks, and incentives that shape collective behavior. The focus moves from monitoring individual entities to understanding system dynamics, from measuring stocks to tracking flows, from static balance sheets to behavioral patterns. Regulatory philosophy evolves from preventing specific outcomes to building general resilience. Institutions adapt by broadening their sense of risk. Models remain, but they are no longer treated as complete. Judgment regains importance. Preparedness focuses on flexibility rather than prediction. The goal becomes the ability to respond to unfamiliar stress, not just withstand known shocks. Stress testing incorporates scenarios that have never happened. Red team exercises challenge assumptions. Organizational cultures shift toward encouraging dissent and rewarding those who identify emerging risks rather than punishing pessimism. Markets absorb the lesson unevenly. Confidence returns, but it is tempered. Volatility is no longer dismissed as noise. Correlation spikes prompt investigation rather than surprise. Stability is measured not by calm, but by recovery under uncertainty. Risk premiums reflect genuine uncertainty rather than historical volatility. Investors demand compensation for factors they cannot model. The pretense of precision gives way to acknowledgement of irreducible uncertainty. Looking back, the next crisis reveals a paradox. The more a system learns from history, the more it risks becoming trapped by it. Preparation is essential, but only when it leaves room for imagination. Safety comes not from certainty, but from humility. The institutions that navigate crisis best are those that maintain skepticism about their own preparedness, that invested in understanding novel risks even when they seemed improbable, that preserve flexibility even when efficiency tempted rigidity. The future of financial stability will depend on resisting the comfort of familiar warnings, on listening for signals that do not fit models, and on recognizing that the most dangerous risks are often those that look least like risk at all. This requires cultivating institutional cultures that reward curiosity over certainty, that encourage challenge over consensus, that maintain vigilance even during calm periods. It requires accepting that perfect prediction is impossible, and that resilience depends on rapid response rather than perfect foresight. Because the next crisis will not look like the last one. It will exploit different vulnerabilities, emerge through different channels, and require different responses. The only certainty is that it will surprise those who assume it will arrive announced and recognizable. Preparation means not just strengthening defenses against known threats, but maintaining the capacity to recognize and respond to unknown ones. Sometimes the smallest shift in perspective becomes the beginning of a new future. Recognizing that vigilance must extend beyond familiar patterns, that assumptions must be continuously tested, that confidence is most dangerous when most widely shared. These insights may offer the best defense against the crisis no one sees coming. What the next